I'm afraid, because where I was, the internet was just too shaky. I'd written it before I went. It was actually a great week, really, but has left me with quite a bit of work to catch up on, as you can imagine. So I've still got a supplement prepared for tomorrow morning, but today I'm going to release what was last week's supplement, which was called The Big Reveal. And as you'll know, I like to start with a quote, and the quote I used was, "Gee," I said, feigning surprise. "Who else would be stupid enough to volunteer for a quest like this?" And that was from Rick Riordan, The Lightning Thief. So before I get started in earnest, make sure you save the date for the next property business workshop. We are already taking bookings Tuesday, the 1st of October. This time around, we're covering exits with two main objectives. Firstly, planning your own exit, which people do very poorly in my experience. And secondly, so that you can understand other people's exit plans or lack of them and assist with them when looking to buy a portfolio or a business. Help the vendor get what they want, need and deserve, and work towards a real win-win situation. As always, it will be an action-packed, content-filled day, which will stand alone in helping to advance your understanding as a property business owner. The link for this is live, and super early bird tickets with a 20% plus discount are available in limited numbers. That's at bit.ly/PBWFOUR. So, welcome to the supplement. We had this week of feigning surprise from our new administration, with perhaps the fakest speech yet to come from Rachel Reeves on Monday about the state of the nation according to the Treasury. The leaks are already out there that she's going to reveal a 19 to 20 billion pound hole in the public finances. If you haven't heard, looks a little careless from someone, doesn't it? But if you put into context that, for example, in June we borrowed £3 billion, more than predicted, it doesn't take much to run up that sort of bill. My personal view is that when the OBR prepares their report for the fiscal statement in late September, early October, we will actually see a significant growth upgrade for the UK, even though massive, widely respected economic foundations and commentators are still pretending we're going to grow at under 1% this year. On the current figures, we're already 1.3% bigger as an economy in real terms than at the turn of 2024. But don't let the obvious truth get in the way, of course. Hopefully she won't pretend she didn't at least see some of this coming and will strike a fair chord. The media are waiting to pounce, that much is for sure, and will call her out on any unseen bits that really were already public knowledge. Anyway, never mind the politics. Here comes the usual taster menu of what's going on in the property market, the macro world, and then a deep dive into this week into Hamptons' research paper published this month about the buy-to-let market and what's been playing out over recent months and years. So the real-time market first, which is a 2-week update as we missed our helping last week because Chris took the week off, the cheek of it. The July sold subject to contract number nudged up £1 per foot to hit the highest so far this year late in the month, £349 per foot on sold prices. That's 6% up on January's 2024 sold subject to contract number. Listings remain very strong, 7% higher than the UK pre-pandemic average on the year to date as people continue to dispose, and also the stock held off the market in 2023 continues to hit the market in 2024. On the bright side, gross sales without fall-throughs are also up nearly 7% on the pre-COVID numbers, 6.7% up on the year, so the percentage of what is selling isn't much different from the pre-COVID market, there's just more of it. Net sales have dramatically increased year on year, 20% higher than 2023 in the same week, but fall-throughs are also smack on the 7-year long-term average at 1 in 4 deals falling through before completion. Remember, that's where opportunity can arise. So, all in all, the election has passed through the market without incident, and this market is inching upwards at a very slow yet very sustainable rate. As interest rates do come down, that will be the accelerant on what is already a market moving largely only at the moment because of inflation. Don't worry, because there's plenty of inflation left in the tank yet, and the one thing that will hold capital growth back is just how slowly rates do fall over the next few years. There's no chance that supply will even match new demand, even if Labour hit their target of 1.5 million new homes. And they won't hit that target, not for lack of trying, but because planning will take time to sort out and still won't be sorted, and departments will be under-resourced. Material constraints won't help, and neither will net zero progress over the next 5 years in terms of what it will continue to do to alter building regulations and the cost of manufacture. And then skill shortages. No one really says it, but more than 1.5 million new homes are needed over the next 5 years anyway, just on the basis of relatively conservative migration forecasts and population growth forecasts. The forecasters are all at sea on all of that at the moment anyway, because of the cost of living crisis, as it really bit in late 2022, and that lowered the birth rate relatively dramatically. Anyway, that's just some of the ways in which I apply Chris's real-time weekly market analysis, for which I'm grateful. Check out his YouTube if you want to watch the show, which is targeted for estate agents primarily, I should say. He's at Christopher Watkin, or there's also a link below. Macro-wise, we move on to the roundup. This week was quieter, and so there's an opportunity to go back and look at the retail sales that there wasn't time or room for last week. This week we've had the PMI flash numbers, which I always like to make room for, the CBI indices for business optimism and industrial trends, both of which printed miles away from their forecasted numbers, and then we close as always with the gilt and swap yields. So firstly, the retail sales. The print was a 1.2% drop year on year as the multi-year slump continued for retail after a bonanza. That was, of course, almost exclusively online during the early days of the pandemic. Cost of living and disposable income after housing costs remain the main reasons for this in my view. Month on month was another drop, 1.2%, and year on year just down 0.2%. Sales volumes overall are about 2.5% lower than they were in 2019. Which when you factor in a population a few percentage points larger than it was in 2019, is more like a 6 to 7% drop per capita in retail sales volumes. On the bright side, once the GDP per capita is back on par, there's room for growth here, you'd think. The only growth in June was in non-food online, which has suffered of late. Everything other than food has been struggling for the past 12 months particularly. Retailers hold on. A sudden improvement is unlikely, but households will have little more money in the pocket in July thanks to the energy price cap having come back down on the 1st. On that subject, the expectation for the price cap in October is a 10% increase from the current level, which undoes the recent good work done in getting the price cap down in July. We're still overdue for a cold winter. I hate to keep banging that drum, which would hurt households more, of course. The S&P PMI flash numbers were out for July. For those who don't follow it closely, there is a flash number about 7 days away from the end of the month, which is then cemented at the beginning of the following month. It's great real-time or nearly real-time information, which also correlates very closely to GDP growth. The index printed 52.7 after a June drop to 52.3, which was mostly blamed on the election. 53 is a great number, so 52.7 is pretty good, although not comparing very well with March to May numbers. But between March and May, we had 0.9% GDP growth, which is nowhere near sustainable in today's UK economy. We'd take 52.7 every month for sure. This split into services at 52.4 and manufacturing at 51.8, which is a 2-year high. The composite index also includes construction and isn't just an average of those two numbers either. That looks like a good sign for construction too. The highlights from the report. Firstly, the sharpest upturn for new business in 15 months. Perhaps just based on slight lulls in June waiting for the election. Staffing numbers increased at surveyed firms at the quickest pace for 13 months, suggesting that unemployment trends upwards are likely over, as I've referred to in recent months. Average prices charged rose at the slowest rate in almost 3.5 years, but note they still rose. Wage pressure is softening, but transport and shipping costs are up, mostly thanks to the Red Sea. The 2024 index average is 53.0, which all else being equal represents a great year, and if we keep that up, I think we're looking at 2% growth for the UK economy in 2024. I think there are zero other economic forecasters predicting even 1.5%, but I'm happy to be the outlier as usual, especially as we're over 7 months in. The business confidence measured by S&P in this report was only slightly below February's 2-year high. The commentary by the chief business economist at S&P is always good, and he highlighted 3 points. Firstly, an encouraging start to the second half of the year with output, order books and employment all growing at faster rates amidst rebounding business confidence with moderated price pressure. Both services and manufacturing are optimistic about the new government. He mentions alleviating price pressures as raising the prospect for a summer rate cut, and he was right, ultimately. But he did give eth and taketh away and cited the Red Sea shipping delays as providing inflationary dangers, whilst also citing that hiring picking back up again might increase wage pressures again, which no one would like. It's a good summary though, because the rate cut really was on a knife edge this time. It's one of the harder meetings to predict since September 2023, when they held rates at 5.25 based on a 5-4 vote, and I'd expect to see the same again. The CBI surveys yielded some slightly different commentary, suggesting slightly lower output volumes in the past month, but with very strong growth expectations in output expected over the next 3 months. The strongest reading since March 2022, 25%. Sentiment fell back to negative on the CBI Business Sentiment Index after it rose in April for the first time in 3 years to a positive figure. The print moved from +9, as it was positive, to -9. Investment expectations were the highest since January 2022 in everything apart from buildings, so increases in product or process innovation, training and plant and machinery. The story in the CBI figures was one of rapidly rising costs in the quarter, including July, 52% compared to the long-term average of +18. That won't calm the Bank of England much. Numbers employed were unchanged, which supports my unemployment forecast commentary, and +16 of firms expect to increase numbers over the coming quarter. So over to the gilt and swaps then, the wider economy looking in okay shape, not pulling up trees, but growing at something like 0.1 to 0.2% per month, you would think. We opened the week at 3.941 on the 5-year gilt yield and closed at 3.9 exactly. A very marginally down week with a very, very tight trading range. The first week we haven't touched above 4% at any point for many weeks, to be honest. Things look quite a lot brighter than April to June this year, and a lot of next week's movement will depend on the detail in the Bank of England report. The yield curve as a whole, though, took an interesting turn. It's now inverted from 1 to 2 years, so 1-year yields are still high, 4.5%. 2-year money has not looked anywhere near this cheap for a long time. It closed at 3.92% this week, meaning a flat curve between 2 and 5 years, and for the first time in a while the 10-year bond at 4.1 is actually trading higher than the 2-year, and that's the inversion that analysts often look at between the 2-year and the 10-year. This flattening usually happens before a recession, but it would still, using the traditional yield curve measurements, be a while out yet, maybe greater than 1 year. The traditional methods just haven't worked in this cycle though, mostly because of the massive distortion caused by the pandemic stimulus. There's also the argument that the base rate is too high, and that is setting an artificially incorrect short-term yield curve. There's a possible argument there as well. There's one more wrinkle though. The curve's also inverted between 3 and 4 years. 3-year money at 4.235 is one I struggle to make much sense of, to be honest. And one explanation is that the yield curve is pointing to a double dip recession in relatively close proximity. A longer form explanation for this isn't really one I can come up with because it doesn't make much sense, but here's the best I can do. The pain for householders is a slow drip. Every month 100,000 or so households drop off a generous fixed rate on their mortgage from way back when, July 22, where rates were still pretty low if they took a 2-year, or July 2019, where rates were lower still if they took a 5-year. The maximum pain in terms of dropping off the very lowest rates actually comes in 2026, because the rates were their very lowest in 2021. What blips there are in the data due to remortgaging activity in 2020, and house buying activity, of course, which is usually about double the remortgage volume in the present day, will become clear in 2025. But a small percentage of households each month, 2 or 3%, are dealing with massive cost increases. Those cost increases depend on 2 things: the rate which you're dropping off from and the rate which you are going on to. And the rate you were going on to took a turn last week, with Nationwide dropping their fixed rates for 60% loans of value to under 4%. The criticism is that first-time buyers can't afford 40% deposits generally, but in the remortgaging world, especially for the 5-year fixers who, regardless of a slow market over the past 18 to 21 months, have still had a nice 20+% bump in their capital values over that time. The rates currently look safe at under 4% on the gilt yields, and it's very clear that the banks are punting on a rate cut in either August or a strong indication of one for September. So the real measurement of the max pain, which is affected consumption, of which there's no doubt, is not data that exists broadly and would need to be mashed together. But as you know, I also watch the cost of new money being issued each month, and also the rate on the stock of outstanding debt. They're currently about 1.25% apart, which isn't massive, but it is about a 30% relative difference when you compare 3.5%, the cost of the existing stock, to 4.75%, the average rate at which people are drawing down at the moment. The way that a Ray Dalio would frame this is that a debt bubble often takes a longer time to deflate rather than popping. And that's exactly what's happening here. The bubble of cheap money will go on for many years for some very large firms, who even in 2035 and beyond will still be holding some bond debt at between 2 and 3%. In 2021, I remember headlines around housing associations raising debt at 0.5%. In the households, the time horizon is shorter, but if the rates are coming down fast enough, then the relative pain in 2026 may well be lower than the relative pain in 2024. And it should be, because all of the 2-year fixed cheap money has gone by the end of 2024, and only the 5-year cheap fixed money remains. I hope that makes sense. So the swaps, before I get into the deep dive, Thursday's close was 3.918 and the last swap traded at 3.842. Not much difference from the week before. The 10 basis point discount seems to have evaporated and maybe suggests a little bit more demand for mortgages, which would fit in with the real-time market numbers as well in terms of sales agreed, etc. The 2-year closed at 3.948 on Thursday. It was 4.57 at the end of May, so it really has tumbled in those 2 months. But the swap money remained at 4.305. So there's a short-term premium being applied there, and the swap market looks a lot less inverted than the gilt market. In plain English, 2-year money still looks about 0.5% more expensive than 5-year money, but 12 months ago it was about 0.8% per year more expensive. So that gap has narrowed as the yield curve has flattened back out. So, is it worth taking a 2-year and then a 5-year fix? It's a constant question I get asked. All I can say is, firstly, I'm not doing that, and secondly, the rate I expect in 2 years' time is about 4.5% to 5% on a 5-year fix. That's in a limited company, which would compare to today's 5.75% or so. No free lunch here, folks, I'm afraid, and I could be completely wrong, as it's certainly happened before. But that leads us to the deep dive. Hamptons produce a lot of decent quality market insight, and whilst I take issue with the transparency of some of where they get the data from, there's a huge market and indeed industry service based on them doing this, because the data across the sector as a whole is alarmingly poor given the size of it, considering the fact that the value of the property in the buy-to-let sector is somewhere near £1.5 trillion. Their summer 2024 market insight is right up to date, published, including expectations from a new government. They kick off by recognising that base rate is much more likely to have a bigger influence on the short-term housing market than anything that the new administration can do, and I'd be inclined to agree with that. The unspoken piece here, though, is that the expectation, whilst we all spend time trying to predict when that first cut is coming, is a slow downward path with the cut once every 3 to 6 months potentially. That's a very easy story to believe for me, but some are still out there thinking the first cut will start with some kind of avalanche of cuts, which is very unlikely without a significantly negative economic event. Hampton's first call was August or September, a nice hedge that made sense. They do recognise that it will be much slower to trim rates than it was to raise them, but let's remember the bank was raising rates at every single meeting. But Hampton's expectation is a market that will pick up pace in the coming months as election uncertainty recedes. However, we saw very little change in behaviour after the election announcement, so I'm not convinced there's a lot of bounce back to come on the back of that. They do particularly cite the prime sector, however, in London, which I don't concentrate on. However, the idea of many of the super rich moving to London to buy prime strikes me as unlikely with the Labour administration in charge. There's a note of the fact that policies are not a million miles different from the Conservatives, but there's definitely an aggressive sounding approach to planning reform at the moment. The questions, of course, are how much difference will it make and how quickly? Hamptons highlight the commitment of the Chancellor to only one fiscal event per year to allow people to plan accordingly, which sounds positive to me, although it potentially increases the need for the emergency budgets. They also pour cold water on the £1.5 million target, simply based on the levers the government can or cannot pull, which is the easiest prediction out there at the moment, let's face it. There's a crossover between some of the King's Speech analysis from last week, so I'll skip to Hampton's views on Section 21 repeals. They note that Rachel has distanced herself from a study recommending rent controls. She can see a case for caps in some locations, but doesn't favour a blanket approach, and that's the party line. There's a powerful sentence that I hope Angela Rayner reads in this report. There are risks for tenants too. The removal of Section 21 could create a public database of tenants who have been served with a Section 8 notice instead, mostly because they were in arrears or had committed antisocial behaviour. Since it will become more costly to evict problem tenants, landlords may increase their vetting processes, making it difficult for some tenants to find a home. As the sector becomes more professional, these tenants will either be housed by the council, or the council will discharge their responsibility on the basis that non-payment of rent is equivalent to intentional homelessness. This argument, as I understand it, will also depend on vulnerability, but I expect new arguments in this space when the law changes, simply because of the pressure on local authority housing budgets. The thing is, there's nowhere for these people to go. This is a gigantic problem that will occur once Section 21 is repealed, and let me spell out why. Currently, the language in the King's Speech suggests that the belief is that Section 21 is used frivolously by greedy landlords looking to re-let properties at higher rents. Does this ever go on? Of course it does. Does it explain even 50% of Section 21's? No way. 30%? I wouldn't think so. I'd wager strong money it's under 20% of the reason for Section 21's. The real reasons over the years are, firstly, it's the least line of resistance to regaining possession of a property. Secondly, rent arrears. Thirdly, antisocial behaviour. Fourthly, moving back into the property. Fifthly, letting the property to a family member. And six, selling the property. Now, those are not supposed to be in any kind of priority order. And of course, that order would have changed massively since the increase in interest rates, of course. There are far more sales of necessity out there from landlords at the moment, where they're just not making any money or are losing money each month. So Section 21 is gone, and there will be possession grounds for some or all of the above. Not the least line of resistance, of course, and some of those are already in place. There's still talk that some of those will be beefed up, because the ideologues think they will fix a significant problem with that stroke of the pen in the Renters' Rights Bill, and they just won't. This will create a lot of new demand for temporary accommodation that won't be temporary. Section 21 is at the moment the standard practice. Rent arrears will be dealt with by Section 8 much more widely, and CCJs etc. will become the norm rather than the exception. This will in turn affect the future viability of these tenants getting an AST or equivalent in the private sector. For tenants who do get into these situations, whether it's because of bad luck, poor decisions, or a mixture of both. The thought of temporary accommodation growing even more from the point we're already at is a frightening one, but I can't see any different outcome at this point. So, back to the report. Hamptons expects tax tweaks from outside of the income tax, national insurance and VAT promises, and we'll see how Rachel Reeves' speech plays out. There's a wave to the extra 2% charge for non-residents on stamp duty, moving up to 3% now, meaning a minimum 6% charge for any foreign national spending 40k or more on an investment property. Hamptons provide a nice graphic about the feasibility of these changes, suggesting that renters reform won't be quick if it's going to start from scratch. They also point that increasing affordable homes when big house builders are cutting back on output will be difficult. They judge that the new town suggestions won't play out in this parliament. The very hardest bits of freehold reform, the 30 billion black hole comes back to the surface, and compulsory purchase reform alongside affordable housing delivery. And move on to some fascinating mortgage stats then. Over the past 12 months, 758,000 mortgages were paid off, which is 144,000 more than were taken out. Or, put another way, for every 10 mortgages taken out, 11 were paid off. In 17 years, there's a 1.2 million drop in the number of outstanding mortgages. Even when looking at the start of this century, there are around 500,000 fewer outstanding mortgages. That's quite an incredible change, and exactly why I believe the government needs to reform options for equity release and get some of this trapped wealth circulating throughout the economy. I have referred many times to the reason why we didn't have a debt crisis. Every UK mortgage taken out by a homeowner since 2012 was subject to a pretty robust stress test, including a pay rate of 5.5% mostly, even when pay rates were far, far lower. Now we're there where pay rates are 5.5% or higher on variable, but these stress tests being robust has prevented swathes of repossessions. What I haven't concentrated on, however, is what replaced these stress tests when it was clear that the 5.5% rate was going to be exceeded. The stress rate has hit various rates since then, up to 8.5% or perhaps more. Data are limited. That new stress test has of course made affordability even tighter, and until we get back to 5.5% as a stress test, which looks some time away, the market simply can't be the same as it was. Hamptons point out that higher rents could make it even harder to save deposits, of course, and if the government could unlock a way to support buyers, this would reverse the trend in the mortgage market. Without Bank of Mum and Dad, though, and a fairly revolutionary approach to equity release that I've outlined in previous supplements, I don't see how this can be done. I've skipped the Hamptons macro analysis as much of it is somewhat outdated and looks back a few months. The last section I'll focus on is their lettings market analysis. The remainder simply points out that many properties have applied for business rates in the wake of a doubling of council tax regimes. This is legitimate, of course, because these properties are being used for business purposes if they're holiday lets. Their lettings headline is second round of rental growth, which makes sense. The graph here in the report is enlightening and supports my recent analysis of the past few months, which has highlighted that the ONS rent sample, which includes about 22% new tenancies over the past 12 months and 78% existing tenancies, are moving up more than the rent for new lets. Existing tenancies are catching up. Hamptons numbers are 6.4% up for new lets and 8.3% for contract renewals. 62% of new lets are at an increased rent, compared to 88% of tenants who renew contracts. Renewals are paying an average of £1,159 per month, which is 13% below a new let. £178 per month saved on average is the stay put dividend, is one way of framing it. To move, there needs to be less home, less space, or more money, or both. Tenants moving are at levels last seen during the pandemic, according to Hamptons, i.e. turnover is so low. 15% fewer tenants moved home in 2022-23 compared to the pre-pandemic period 15 to 19. That's come from the English Housing Survey. Hamptons predict 1 million moving in 2023-24, which would be 17% fewer than the 15 to 19 period on average. Hamptons have open market rents as up 38% since May 2018. Existing tenancy rents are up 21%. The gap is closing. That's what their graph shows. The 2024 estimate is that rents will be up 6% across the board, the same number as wage inflation and services inflation, interestingly. This week's image that I used was based on regional annual rental growth and tells a story. London landlords are tied with Midlands landlords on rent increases, although new lets are also still racing forward in the Midlands in terms of costs. Scotland continues to show the highest increase in new lets, with the badly misguided rent cap damage still filtering through to the market. Hamptons closed this section with some interesting examples. A one-bedroom home is now the same price as a two-bedroom was 20 months ago, and a two-bedroom now costs the same as a three-bedroom did 20 months ago. When rents were increasing 2 to 3% per year, this was more like 50 to 70 months before it happened. There were 39% fewer homes to rent in May 2024 than May 2019. Hamptons explained this by saying that supply is down so much. I'd also point to the demand difference since May 2019, with a vast increase in net migration in the interim. Homes are, of course, as well on the market for shorter void periods too. Inner London rents are up 35% since 2021. Now remember, they had taken a haircut, so it's not the fairest starting point because of the pandemic. They're actually down on new lets by 2.3% in 2024 so far. Perhaps they'd overperformed over that last few years and affordability has just bitten in reality. Not enough people can afford those rents. Well done as always for getting to the end. I hope you enjoyed this week, and there will be plenty to consider next week, which will be released tomorrow, with a Bank of England meeting and also Rachel's speech on Monday giving us a tax steer. Thanks for your attention and engagement. I hope it was of use. Don't forget you can book your super early bird tickets for the 4th Property Business Workshop of the year at bit.ly/PBW4 on Tuesday the 1st of October. And as you know, there's only one way to deal with all of this continual noise and the unfolding chapters of this new dawn. Keep calm, always listen to the supplement, and carry on. Thank you.